Good morning, everyone, and welcome to this press conference for the Fall 2018 Global Financial Stability Report. It's my pleasure today to introduce you to the panelists from the IMF's Monetary and Capital Markets Department, Director Tobias Adrian, Deputy Director Fabio Natalucci, and Anna Ilina, the head of the Global Markets Analysis Division, which is the division that writes Chapter 1. Tobias will summarize the main findings of the report, and then we'll be happy to take your questions. If you're watching us online, please send your questions so that we can take them, and you have the interpretation as needed. Tobias.
Good morning. We would like to begin by thanking the Indonesian authorities for their thoughtfulness in hosting the annual meetings. And we would like to express our sincere condolences to the families of those who suffered during the recent earthquake and tsunami here in Indonesia. Our latest Global Financial Stability Report finds that the global economic expansion remains strong, supported by still easy monetary policy. The global financial system is stronger now than it was before the global financial crisis, thanks to a decade of reform and recovery. However, financial imbalances continue to build up, and the new financial system remains untested. Short-term risks to financial stability have increased, and risks in the medium term remain elevated. So, while there are reasons for optimism, this is no time for complacency. Since our last report, 6 months ago, the balance of risk in the economy has shifted to the downside. Global growth has plateaued. Trade tensions have escalated. Some emerging markets have experienced capital outflows and asset price pressures. In addition, policy uncertainties have increased in the number of countries. In some advanced economies, some investors have grown overly confident and even complacent. Looking ahead, financial stability risks could rise in the near term. Several potential developments could trigger a sharp tightening in financial conditions. An intensification of concerns about emerging markets could lead to larger capital flows. A broader escalation of trade tensions could discourage investment and sour risk appetite in financial markets. An increase in policy uncertainty could undermine investor confidence. And a faster than anticipated normalization of monetary policy could dampen real activity and lead to repricing in asset markets. Any of those concerns could become trigger events that could expose the vulnerabilities that have been building during years of accommodative monetary policy. This new report outlines a range of concerns. First, the level of debt held by governments, companies, and households is high and rising. The total debt of those sectors in the key 29 countries with large financial systems has grown to about 250% of their combined GDP. Second, emerging markets and low-income economies have increased their borrowing from other countries. Countries are vulnerable to further capital flow pressures when they have large borrowings, when they do not have adequate capital buffers, or when they lack a strong domestic investor base. Our new capital flows at risk analysis suggests that, in the medium term, there's a tail risk, or a 5% probability, that emerging markets could face debt portfolio outflows of around 100 billion over a period of 4 quarters. That would be a significant reversal of the trends seen in recent years. Third, asset valuations are stretched in some markets. Corporate bond spreads are compressed globally, valuations in US equity markets are elevated, and some housing markets, especially in some global cities that serve as the world's financial centers, are richly valued. Fourth, banks are stronger than they were at the time of the global financial crisis, but they still face some challenges. Banks have increased their capital and liquidity, but many banks remain vulnerable due to lending to highly indebted borrowers, holdings of illiquid and opaque assets, or reliance on foreign fragile currency funding. Beyond our analysis of current financial conditions, Chapter 2 of our report looks at the financial regulatory agenda 10 years after the
10 tahun setelah krisis keuangan global. Temuan kami mencakup hal sebagai berikut. Kita ada alasan untuk bersikap optimistis dengan adanya kemajuan dalam penguatan sistem keuangan global dan juga standar-standar pengawasan.
implemented. Supervisory stress testing has been broadly adopted. Many jurisdictions now have a macroprudential framework. Some shadow banking activities have been curtailed or transformed into safer market-based finance. Looking ahead, it remains crucial to strengthen the resilience of the financial system by addressing financial vulnerabilities. Policymakers should ensure that the post-crisis regulatory reform agenda is completed and implemented. They should resist calls for rolling back reforms. Central banks should continue to normalize monetary policy gradually, and they should communicate their decisions clearly. Emerging market and low-income economies should build buffers against external risks, should pursue exchange rate flexibility, and should consider timely, targeted foreign exchange interventions. Regulators should address vulnerabilities by deploying micro and macroprudential policy tools, including supervisory capital buffers, where appropriate. They should also develop new tools to address vulnerabilities outside the banking sector. For example, they should tackle underwriting standards in non-bank credit intermediation and liquidity risks among asset managers. Regulators and supervisors must remain attuned to new risks, including possible threats from cyber risks. They should also support fintech's potential contribution to innovation, efficiency, and inclusion, while safeguarding against risks to the financial system. To sum up, this is a time for more proactive measures to safeguard financial stability. Confidence must not become complacency.
Thank you, Tobias. Just to mention that Chapter 2 that was just referred here has already been released by the IMF last week and is available on our website. We're ready for your questions. Please identify yourselves and as much as possible, keep the answer, the question short. Let's start with Alex of fourth row there, please. Microphone's coming from behind.
Alex Brummer from the Daily Mail in London. Could you tell us how resilient you think the financial system will be, or the banking system will be, to absorb the shock of Brexit? In particular, the clearing, the CCPs, the central clearing parties. How much work has been done to make sure that that is resilient? And do you think this is a real risk to the global economy?
Thank you for your question. So let me step back for a second maybe and provide a framework how we think about Brexit in terms of financial stability risk. So the focus obviously in the report is primarily on financial stability risk. We take no stand in terms of what the odds of Brexit deal are or not, nor the severity that may come or what the ultimate deal may be agreed between the UK and the EU. So it's purely a financial stability assessment. This financial stability risk, of course, will be diminished the more prepared the private sector is and the closer the cooperation between the European and UK authorities. Now, that said, we identify broadly two sets of risk. One, short-term transitional risk, as they relate to contractual risk, for example, for derivative contracts, as you indicated, including CCPs, and the recognition of CCPs and the ability to provide services cross-border. It's one of the issues that relates to derivatives contracts. Continuity of contracts primarily is the concern here, although we think that these contracts remain valid in principle. It relates also to insurance contracts. There are operational risks related to banks, insurance companies, asset management, and so on. Those are like transitional short-term risks. There are also medium-term challenges that relate to the ultimate deal that will be reached. And so those have to do with the risk of fragmentation of liquidity, the possible duplication of trading venues and related inefficiencies, risk management issues for financial institutions, as well as data sharing. So generally speaking, the policy recommendation here is that the private sector should continue to be prepared and prepare for whatever the ultimate Brexit deal is, that authorities should continue to engage with the private sector and make clear what the contingencies are in the event of a hard Brexit, as well as, of course, be ready essentially for whatever the ultimate agreement will be.
Yes. Yes, please. Well, can we get the microphone for him, please?
Sorry, just one quick follow-up. What about the shock effect of a cliff edge Brexit? Wouldn't that have a disruptive effect on financial markets and the whole financial system?
I mean, the issue obviously is an issue of continuity of financial services. So to what extent financial services will continue to be provided and the extent to which cross-border flows, for example, may continue. That requires taking a stand of what the likelihood the Brexit deals are and what the ultimate deal is, which at this point, I don't think we will speculate on that.
A representative from Brazil in the first row.
Ricardo Leopoldo, Agência Estado. Mr. Adrian, you said about the trade tensions, and it's very clear that the IMF, when you read the World Economic Outlook and also the Global Financial Stability Report, that has a clear concern about the increase of the trade tensions. The question is this: how the trade tensions would escalate in a way that could put in danger the financial stability in the world? And the second one, a small one, is about, can you give after some details, more details about the information that you provide, that there is 5% of risks to outflow for emerging markets in a period that you said perhaps 4 quarters. Thank you very much.
Yeah, thanks for the question. So the first question is about the impact of trade tensions on global financial stability. And the channel that we're highlighting in the Global Financial Stability Report is the confidence channel. So the impact of the trade negotiations or the trade tensions on investor confidence. What we have seen already in China is that financial conditions have tightened significantly this year, and the trade tensions are one of the factors that have led to this decline in investor confidence in China. Of course, the Chinese authorities have started to undertake expansionary monetary and fiscal policies in order to offset this shock to confidence. Now, globally, financial conditions remain easy, and what you can see in equity markets in particular is that certain sectors that are particularly exposed to trade, so for example, those Chinese companies that are particularly reliant on exports to the US, or US companies that are particularly reliant on exports to China, those companies have underperformed relative to the broader market in the US or respectively in China. But broadly in the US, financial conditions do remain easy. And the danger is that at some point, those trade tensions are going to adversely impact investor confidence, hence global financial conditions. And we know from economic analysis that those confidence shocks can have significant adverse consequences for macroeconomic activity. So there's really a tight macro-financial link that can give rise to downside risks. And we are quantifying those downside risks. So if there's a long-lasting shock to the investor confidence coming out of the trade tensions, that can generate significant downside risks for the global economy. We have a box where we're quantifying that kind of mechanism. Secondly, you are pointing to another calculation that is about our baseline assessment of what the monetary policy tightening is going to do to emerging markets in the medium term. So what we have seen over the past 2 years is that the Federal Reserve has tightened monetary policy. So interest rates have increased in the US. The 10-year rate is now over 3%. And it has also started to normalize its balance sheet. And furthermore, the dollar has appreciated recently. So those are outcomes of the tightening. And in our assessment, tightening is going to continue. So that is going to put further upward pressure on interest rates, further upward pressure on the dollar. And in general, financial conditions for emerging markets are expected to tighten going forward. So that is going to trigger some outflows of capital that has flown very strongly from advanced economies to emerging markets in recent years. And so that flow of capital is going to slow down somewhat. And in adverse scenarios, that can be an abrupt reversal of flows. And this is exactly the $100 billion number that you're citing. So in an adverse scenario where global financial conditions are tightening, we do expect that such a capital flow reversal from the advanced to the emerging markets might lead to a sharp, reversal of capital flows.
Thank you, lady in the third row, please. Sorry, the lady. No, yes.
Good morning. I'm Winnie from the Jakarta Post. Would like to ask questions about Indonesia in general. How do you see the current financial stability in Indonesia, looking at the country's current economic conditions, such as the debt levels, rupiah depreciation, and widening current account deficits, and also the risk of capital outflows? And how do you think is the progress of Indonesian authorities and central bank so far in terms of addressing the financial stability risks, and what's your recommendations to improve it? Thank you.
Thanks very much for that question. So the question is about the Indonesian economy. Indonesia has strong macroeconomic performance. The growth rate projection of the WEO is around 5.1% for this year and for next year. Now, that growth rate has been downgraded a little bit because of the increase in oil prices. Of course, Indonesia is a net importer of oil. And that is also one of the reasons why the currency has depreciated this year. Indonesia does have a current account deficit of a little bit more than 2%. And so the combination of higher oil prices that went from roughly 60 to close to $85 this year, that has been associated with a depreciation of the currency. Our advice to emerging markets such as Indonesia is that this kind of flexible exchange rate adjustment to adverse shocks is actually a good thing, right? So when a country is hit by an adverse shock, such as the increase in oil prices, allowing the exchange rate to depreciate is a shock-absorbing development. And why is that so? Well, you know, think about it from the perspective of international investors, right? As the currency has depreciated, investments into Indonesian securities, such as government debt denominated in rupiah, has now become more attractive because the currency has depreciated so much. So because there's a current account deficit, Indonesia has to fund itself externally from international investors. That is why an exchange rate depreciation can be a shock absorber. And so that is actually a good thing in our advice. Now, of course, the Central Bank of Indonesia has also intervened in foreign exchange markets in order to make sure that liquidity conditions in the FX markets are orderly, and that is also very much consistent with the IMF advice on how to stabilize macro financial conditions. You want to add something on Indonesia?
Writers in the second row, please.
Thank you. Hi, David Lauder with Reuters. Just wondering, the last crisis was really triggered by a collapse in housing prices in the United States. As you look forward to what might be storm clouds for the next crisis, I'm just wondering sort of where that vulnerability might be. Is it financial asset prices that have gotten frothy? Is that likely to be sort of a collapse in those prices under one of these scenarios that you've described here? Is that possibly the trigger for the next crisis, or is it just unknown? Thank you.
Yes. So in our financial stability framework, we distinguish shocks and vulnerabilities. You know, our financial stability assessment relies on assessing to what extent vulnerabilities have built that can lead to sharp downward dynamics if adverse shocks realize. There are many adverse shocks that can realize, but how bad of an impact that has on macroeconomic activity depends on the level of vulnerabilities. And so we see three particular vulnerabilities that we worry about. So one is the overall level of debt in the non-financial sector. That has increased to around 250% of GDP. So there has been a sharp increase of debt in the non-financial sector. Now, of course, the banking sector is a lot safer. So there's more capital and more liquidity in the banks, and banks now have a resolution regime. So we don't necessarily envisage a return of the 2008 crisis, but there is a lot more non-financial sector debt out there. So that is one particular vulnerability. A second vulnerability is that while the banks are safer, there's a lot more credit intermediation in the market-based financial system that is undertaken, and we do see a deterioration of underwriting standards to some extent there. So perhaps Fabio can elaborate on that a little bit in a moment. And then thirdly, of course, there are some countries, such as China, where the run-up of debt has been particularly fast and where there's a large shadow bank system that is still operating. Of course, the Chinese authorities have realized that the high level of debt is a financial stability risk, and they have tightened regulations, and those are steps that we're supporting very much. So these are sort of like the levels of vulnerabilities that have built up. So there are different vulnerabilities, as you point out, compared to the vulnerabilities that we saw 10 years ago, but they're still concerning vulnerabilities. Now, the trigger could be adverse shocks in different ways. For example, you know, inflation that is higher than expected in the US that will lead to a sharper than expected tightening of monetary policy at some point. That could be one trigger. A disorderly Brexit could be another trigger. And, you know, we list a number of other risk factors that could realize. And of course, the first thing that would happen is a sharp reversal of financial conditions. So global financial conditions have tightened a little bit in the past week, but they remain fairly easy by longer-term historical standards, right? Equity market valuations are fairly elevated, credit spreads are fairly tight, volatilities are fairly low, and so overall, asset prices are fairly elevated, and so there could be a sharp adjustment at some point in the future. And then it's this interaction between the buildup of vulnerabilities and the decline in asset prices that can generate adverse implications for macroeconomic activity. So do you want to say a little bit more about the underwriting standards and credit
So
markets?
as Tobias mentioned, essentially we follow a number of vulnerabilities that you can think of as amplifiers. So debt leverage is one. We look at asset valuation is another one, liquidity and maturity mismatch, FX the mismatches, interconnectedness. And so specifically to the asset valuation, the report highlighted a few asset classes where valuation might be stretched. One is equity prices in the US, where we think that there is somewhat stretch based on fundamental values. Then credit, so credit spreads are very tight. Tied by a number of measures in absolute terms, when you account for default risk, when you account for leverage, and underwriting standard. It's one of those features that likely contributed to the overvaluation in the credit space. One difference, perhaps, if you compare to the crisis 10 years ago, that some of these products were being financed on leverage, so there was a lot of financial leverage in the system that would actually contribute to the overvaluation. Now, our assessment, in part because the banking sector is safer, is that level of financial leverage in the system is much lower, which means if there is a price adjustment, essentially a reassessment of valuation of credit, because there is less leverage, less financial leverage in the system, the price adjustment would be less forceful than perhaps we have seen in the past. Related to this, also part of credit, as Tobias mentioned, is being now intermediated outside of the banking sector. And so that could be one issue if you consider what kind of tools are available to intervene into what we used to be called the shadow banking sector or market-based finance, whether there are tools, whether there are data, there's visibility. So there is, in some sense, one concern there.
And let me just add one more vulnerability. Of course, with the tighter regulations, the market-making activity has changed quite dramatically. And we don't know yet how these changes in the market making, so the broker-dealers, broker-dealer assets used to grow very fast, and then they collapsed in the financial crisis, and they stagnated after the financial crisis. So we don't know how market making is going to act in a sharp adjustment of asset prices. We have a box on market liquidity in the Global Financial Stability Report, where we point out that high-frequency trading activity has become much more important today compared to 10 years ago. So the traditional market makers, like the major investment banks, are relatively less important, and these high-frequency trading firms are relatively more important. And we don't know yet to what extent that kind of market making is resilient relative to very large adjustments, downward adjustments in asset prices. It's just sort of like an unknown that is important to keep in mind.
So I think generally speaking, a couple of words on liquidity. So our general assessment is liquidity in normal days seems to be ample and available. We have seen, though, an increased frequency of these flash crashes or events where liquidity goes away briefly for a period of time. Now, they haven't had major macroeconomic impact so far, and so the assessment remained positive, but we caution that the possibility that essentially that they could be more frequent going forward, and that as rates continue to go higher because of normalization of monetary policy, as the macroeconomic environment changes, we need to continue to monitor essentially liquidity conditions.
Thank you. Gentleman in the first row, please.
Good morning, Tobias. Helmer Preuss from Alliance News. Could you address the situation in terms of the Forex intervention? What are your recommendations there? because I come from South Africa and the Reserve Bank doesn't have an intervention policy. Their policy is no intervention.
Yep.
And then secondly, in terms of vulnerabilities, have you modeled what happens if Italy exits Eurozone but remains in European Union?
Absolutely, yeah. So let me start with South Africa. So, so South Africa is an economy where foreign exchange hedging instruments are well developed. So corporates can hedge their FX exposure. Say when a corporate issues debt in US dollars or in euros, it can readily hedge the foreign exchange risk in OTC markets, in derivatives, in FX swaps, in futures, or other forms of derivatives. In those circumstances, as I pointed out earlier, the exchange rate is a useful buffer for adverse shocks. Of course, South Africa was hit by adverse shocks. It had 2 consecutive quarters of negative growth. And so the depreciation of the rand makes investments into South Africa that much more attractive. And so it allows corporates, banks, and the sovereign to continue to borrow. So the recommendation of the fund is to use exchange rate flexibility when these domestic markets are well developed. You know, other countries where that is the case is, for example, Australia or Canada, you know, where large fluctuations in exchange rates are used as a shock absorber, and that works very well. Now, of course, there are other countries where derivatives markets are not developed all that well, and there, you know, some form of FX intervention to make sure that FX markets are orderly can be useful. Now, in terms of Italy, as you know, there was a preliminary budget that was passed, that was proposed. I'm sorry, it wasn't passed yet, it was proposed. And the budget deficit was somewhat higher than had been expected by markets. As a result, Italian sovereign spreads have widened quite a bit. And yesterday in the trading session, they continued to widen. So we really have to look at the political process, what's going to happen, whether they will get to some sort of compromise that markets are going to judge as being sustainable. So we are, of course, discussing the Italian situation, but we don't provide particular numbers for the kind of concerns that you raised.
I'd like to take the gentleman here in the first row and then in the second row afterwards.
My name is Obinna from This Day in Nigeria. Andrea, earlier you talked about the need for regulators in emerging markets to develop to develop new tools to tackle financial system risk. Specifically for Nigeria, we've seen some form of outflows. What are you recommending to the monetary policy authorities? We've seen tight monetary policy. Are you advising that they continue on that path? And for the fiscal authorities, what form of response will you advise them to adopt? Thank you.
So thank you for your question. So Nigeria, like many other emerging market countries, has come under market pressure since mid-April. It was a combination of factors that basically affected emerging and frontier markets. It started with a sharp appreciation of the US dollar in the context of rising US interest rates. And of course, you know, emerging markets and frontier markets being active borrowers and hard currencies are very sensitive to changes in external financing conditions. So that affected sort of the broad emerging market asset class. But what we can see very clearly is that those countries that had stronger economic fundamentals and policy frameworks and less external financing needs and external imbalances have been clearly less affected. Also, some of the outsized currency moves that we've seen, like in the case of Argentina and Turkey, have been driven largely by country-specific factors that are not necessarily related to this global environment. And of course, in the case of Nigeria, there is one other important driver that always affects its external borrowing costs and economic conditions more broadly, and that's oil. So Nigeria, being an oil exporter, is obviously very sensitive to changes in oil prices. In terms of policy responses, of course, flexible exchange rate is the first line of defense. Allowing exchange rate to act as a shock absorber is helping the economy adjust to the new external environment. In terms of FX interventions, of course, FX interventions might make sense in certain circumstances, but then one has to consider how exchange rate is valued relative to fundamentals, what is the level of reserves, whether there may be other policy tools that might be more appropriate in country-specific circumstances, and so on and so forth. Another thing that I wanted to mention is that given that we are still sort of in the relatively early stage of monetary policy normalization in advanced economies, one can expect global financial conditions and external financial conditions for emerging markets to remain challenging going forward. So this is likely to be a sort of relatively protracted period of volatile capital flows and pressures in the markets. And therefore, one in this situation, one should use foreign exchange reserves judiciously, thinking about future maybe more extreme periods and bouts of volatility. Thank you.
Stay on emerging markets. The gentleman in the second row, please. This will be a question in Spanish. So, danos un segundo para poner los auriculares.
Question en español.
Buenos días, señores. Jesús Antonio.
Good morning. I'm from Colombia. Since 2013, I have been attending these meetings, and I was pleased when in 2015 they identified Indonesia as the venue. So I thought it would be great to be able to make that trip. When you look at debt, you see this as a problem of governments. But we look at 21 countries. What about all the other countries? And also, what about other types of debt? Debt in families, for instance, and also corporate debt. Thank you very much.
Yes, thanks so much for the question. Let me just repeat the question here for others. So the question is about debt as a vulnerability. So we focus in the report, of course, on the one hand on debt in the financial system, but then also on debt in the household sector, the sovereign sector, and the corporate sector. And one of the key considerations from a policy point of view is not only the level of debt, but also who has access to finance. So what is the level of financial inclusion in an economy? So are households and corporations able to borrow in financial markets or from banks? And what we have seen in recent years is that new technologies, what we label fintech, have really changed and improved access to finance for households in a number of countries, including low-income countries and emerging markets. So, for example, in Kenya and in some other sub-Saharan African countries, fintech through mobile phones has vastly increased access to finance and has really spurred a new form of entrepreneurship, new businesses, and new forms of income. We have also seen that in China, where fintech is very large. This is driven by the large tech companies in China that have started to act as lenders as well, and to provide payment services as well. So these kind of fintech developments and new technologies really can increase financial inclusion and can foster growth. Of course, at the same time as they foster inclusion and foster growth, they too come with new risks. So one risk is the cyber risk. They all rely very much on technologies such as mobile internet, and they're subject to cyber risks. Secondly, they start to be large in some countries. So some countries now have a majority of their financial intermediation via phone operators or via mobile banking. And that brings with it a new set of financial stability risks that have to be considered carefully. Tomorrow, there will be an event on the Bali FinTech agenda that broadly outlines our thinking, the thinking of the IMF, the International Monetary Fund, and the World Bank on fintech-related issues. And I would recommend all of you to attend that session. That will be very interesting and pointing to future opportunities and risks.
Yes, the Bali FinTech agenda is tomorrow, 1 p.m. at the Mangupura room in the first floor. Please, Phil, third row on this side. Phil Aldrich.
Hi, Phil Aldrich at The Times in London. You mentioned, Tobias, that the house prices in these global cities are richly priced. I just wanted, what the risk is about, highly priced houses in capital cities such as London, is there what's the financial stability risk? How bad is this risk? And what policy should be taken? Should speculative capital inflows into these property assets be curbed or constrained in some manner?
Yeah, thank you for that question. Of course, financial crises are often associated with sharp adjustments in housing prices. That has been the case for many, many decades and in many countries across the world. So when we see an increase in housing prices, we worry because housing finance is often associated with mortgage debt, right? I mean, from a household perspective, mortgage is often the main vehicle through which households can take on leverage, but that exposes them to house price risks. And the banking sectors are exposed to the houses because in many countries around the world, mortgages are one of the major assets on bank balance sheets. So what we worry about is when we see economies where housing prices are rising and household debt is rising at the same time, and there is also potential for underwriting standards to deteriorate. So our recommendation for many jurisdictions where we see such developments is to deploy prudential tools actively. And many jurisdictions have done that. That includes, for example, cities such as Hong Kong, but also jurisdictions such as Canada and Australia, where authorities have deployed macroprudential tools actively in order to make sure that underwriting standards are conservative, are safe. So they've put limits on DTI ratios, debt-to-income ratios, loan-to-value ratios. They have triggered countercyclical capital buffers in some jurisdictions, and they've used a number of other tools. And this is something that we generally support at the IMF.
I would like just to add one quick thought. There's a section on policy recommendation in the report that looks at macroprudential tools that Tobias mentioned. And there's a table that looks at the availability of these tools across different sectors. And so housing is one, in fact, where there are some tools that are available, and in fact, they have been used in some jurisdiction, and so that offer the possibility of actually studying what the impact are and things about possible cross-border effect too.
Just wait for the microphone.
Sorry, just on London, are London house prices too high, and should these tools be being used then?
So in this report, we don't look at valuations of specific cities, but we're working at the moment on a chapter that is looking at valuations across countries and in different cities, including in London. And that chapter is going to be published in April in the next GFSR. So we will give an answer to your question at that point.
Thank you. I'd like to take the lady in the back, please.
Thank you. I'm a reporter from Caixin in China. My question is about Chinese government's move. So the Chinese government has slowed the pace of deleveraging and encouraging the local government to speed up the sale of bonds, while it is also trying to contain the impact of the trade tension with the US. So what do you think of this move, and to what level do you think that China can continue to build up the debt, to support growth without triggering a crisis? Thank you.
Yeah, thanks for the question. The Chinese authorities are undertaking a careful balancing act. Last year, senior policymakers did formulate the objective of moving from high growth to high quality growth, and that means, containing financial stability risks. Of course, as the regulatory tightening has been phased in, these trade tensions have also occurred. And so both monetary and fiscal policies have been eased to some extent in order to balance financial stability goals and growth goals.
Just one quick thought. I think essentially the assessment is that Chinese authorities are well aware of the financial stability risk. Some of the policy recommendations the Chinese have, in fact, they follow through. They've eased monetary policy now and softened the implementation of some of the financial regulatory measure, in part to cushion the slowing of the economy, in part deriving also from trade tension. So the balancing act here essentially is to consider what the appropriate measures are to sustain growth in the short term without contributing to a further build-up of vulnerabilities that could have financial stability implications in the medium term. That's the balancing act that trying to work now.
Gentleman in the front here, and then I'll take you next.
Thank you very much. I'm very happy I got the call for persistence. My name is Chijioke Nelson. I write for the Guardian newspapers, Nigeria. Well, in your report here, you listed, you mentioned a concern about government debts. And in sub-Saharan Africa, yesterday in your report, there was a warning that the governments will have to be careful about borrowing. And my mind tells me that somehow you are referring to Nigeria. Yes, we have the debt there. So I want to know, at that level now, and the challenge of a revenue to match the debt, and the government's hand is still on the trigger to borrow more. What do you think is the implication in terms of pricing? What do you think is the implication too for the private, for the companies, private institutions there, and the rest of the economy, maybe?
Yeah, thanks for the question. So the question is about debt in sub-Saharan Africa. So what we have seen in recent years is an increase in countries that issue debt in international capital markets, sub-Saharan countries that issue debt in international capital markets. And that's a good thing for development, right? I mean, it is good for development to be able to participate in international capital markets, to fund things like infrastructure projects and to sustain investment in countries. Of course, international borrowing has to be balanced with stability objectives. And so countries have to make sure that the level of borrowing is sustainable in the long run so that the country can pay back the debt and the interest rates on the debt even if times get worse at some point. And so that is always the big question, is that sustainable even if economic activity slows for some reason? Of course, in the case of Nigeria, at the moment, as Anna has pointed out earlier, at the moment the rise in oil prices is sustaining economic activity because Nigeria is an oil exporter, but oil prices could decline at some point. And so it's important to have some constraint on how much debt is issued. So as a matter of fact, when you look at debt issuance of sub-Saharan African countries, we do see a sharp slowdown in issuance in recent months as financial conditions for emerging markets have tightened. Financial conditions also have tightened for sub-Saharan African countries. And there is some slowdown in the debt. And so it might be that we see less issuance going forward. Of course, there is going to be quite a bit of need for rollover of debt in 2020 through 2022 in particular. There's quite a bit of debt that is going to come due, so there will be rollover, and hopefully international capital markets will allow that rollover in a smooth fashion.
Thank you. I'll take a last question from the gentleman with the white shirt in the back.
Thanks. It's Miguel Gonzalez from Mexico, El Economista. I would like to know your opinion. How do you evaluate the risk, the cyber security risk? Are the financial institutions prepared, organized, the structure is ready for, I mean, we are seeing growth on financial services, fintech, but our institutions don't seem to be ready to respond in the risk side. And is it a risk in the stability for the system?
Yeah, thank you. Thank you for the question. So when you look at surveys of risk managers in the financial industry, the number one risk that they typically flag is cybersecurity. We have seen the level of cybersecurity attacks rise sharply in recent years, and major financial institutions, as well as smaller banks and even central banks, are under constant attacks, constant cyber attacks. Some of those attacks do lead to losses for financial institutions. There are many examples that one could cite. There are countries in South America that have been under attack where, you know, some banks have been out of business for a couple of days. There are central banks that have been under attack. And, you know, it is a risk. It is a major risk. When we look across countries and across financial institutions, we see a wide variety of practices, both from a supervisory point of view and from a bank risk management point of view. So some countries have supervisory frameworks and regulatory approaches to cyber risks, but some countries don't. And we have a technical assistance program underway where we help countries develop a regulatory framework around cyber risks. We also see that when we look at financial institutions, some institutions have very sophisticated cyber stress tests, and they have backup plans, they have second locations, or some even have third locations, where if their systems get attacked, they can transfer the activities to a backup location, and some of them have a second backup location. So some institutions are well prepared, but some institutions are not prepared at all. You know, one of the key challenges in cybersecurity is that it's not a purely technological challenge. It's also the human element that is very important. Cyber attackers, cyber criminals often use human weaknesses as an entry point into computer systems. And so they use emails and viruses in order to gain access to systems. And it's often the human element that is the weakest element that opens the door to the cyber attacks. So the issue is a complex issue. And we estimate that potential losses could become macro-critical in some countries. So it is a risk that we're taking very seriously and that we are focused on from a regulatory and from a financial stability perspective.
Thank you very much, Tobias. We have to finish, but on this note, let me again reinforce the invitation for the Bali FinTech Agenda seminar tomorrow with the participation of the IMF Managing Director, World Bank President, Governor of Bank of England, and a special participation from the President of Indonesia, where we will be discussing the Bali FinTech Agenda, which is a joint paper of the IMF and World Bank, which importantly for you will be distributed under embargo this morning. So you will have the paper 24 hours in advance of the seminar. The seminar, again, is tomorrow at 1 p.m. at the Mangupura room, which is the biggest room in this convention center. I would like then to thank Tobias, Fabio, and Anna for this press conference, and all of you for your participation. Have a good day, and one final reminder, the Fiscal Monitor press conference starts in 45 minutes in this room with Director Vitor Gaspar and his team. Thank you very much.
Of course, yes.
Can you
stand up? Yes.
Come behind? I think it's easier.
Oh, yeah. Thanks for your question.